Good afternoon. Welcome back to another Money Not Math conversation. Today is Money Not Math number 141, titled How to Invest Better and Live Better. In today's conversation, we're going to be reviewing the 2023 Dimensional Matrix book. Dimensional is one of the core companies that that being Five Stone Financial Group, use to build our custom-built portfolios for our clients when it comes to not only accumulating wealth, but also planning for and enjoying your retirement. So if you have questions about what's in the book, or it's 43 pages long, I'm just going over a small portion of it. It's really in depth. So if you're really, it's like if you really want to study the market, this is a great book for you. Otherwise, if you want to stay high level, this Money Not Math conversation is probably going to cover a lot of the main topics. And of course, I love talking about this stuff. So reach out anytime if you have questions, thoughts, or things you'd like to discuss. Sorry for the beep on my phone there. So, like I said, or if you just want a copy for yourself, reach out and I'm more than happy to send you a digital copy. So, starting off, David Booth, the founder and chairman of Dimensional, says it can be challenging to start a conversation about investing. That's why I encourage having a broader conversation about life as a preamble to investing. Connecting life principles to investment principles is a great way to ground abstract concepts in reality and share universal experiences and feelings. One of the best ways to communicate investing is through stories. Of course, technical data is great, and that's our world at Dimensional. But most people relate better to stories. Having a good investment experience is about more than returns. What matters just as much, maybe even more, is how people feel along their financial journey. And that's really what our business is all about, helping people live better, more fulfilling lives. I hope you enjoy these stories and get to know a little bit more about Dimensional's people. And I think this is important and the reason I'm sharing this is because I think it's important because Dimensional and their experts and their geniuses, they're the ones that really every single day, every minute, every hour are the ones studying the world market. And they're the ones that are trying their best to understand what companies are doing, what markets are doing, what trends are doing to decide what investments or what equity should be held within certain portfolios. That's their job. My job and my partner's job as financial advisors is not what they do. My job is not to sit here all day and study the market and be an expert on the market itself and the world market, because there's way too many companies and there's way too much information out there for one person to do that. Dimensional's got a whole staff and crew to do this. My job is to help my clients understand what their goals are, build trust with them to have real life conversations that, not only can we understand what's happened in the past and where we're at right now, but where we're trying to go in the future, and take that information and take those goals and then go out and pick the right dimensional products or investments or the custom built portfolios or insurance or savings or whatever it is for my clients. And then as time goes on and unexpected life events happen, unexpected market corrections happen, I'm the one here to help my clients make good decisions or avoid bad decisions when it comes to their real life situations. All right. So I know sometimes that gets confusing on what's my job versus what's Dimensional's job and their experts. Hopefully that helps you out. So let's continue on with some stories from some Dimensional staff. And I think they're all extremely impactful, so I hope they're valuable to you. Starting out, The Power of Compounding by Stacey Winning, Chief Talent Officer. Over time, small improvements really add up. I embrace this principle early in my investment life, but it took longer to master in the context of a career. While you're first starting out in the workforce, time ticks by what can feel like a glacial pace, and it's hard to see how all things you learn pay off. Yet, just as the whole is greater than the sum of its parts, incremental advances in your knowledge, expertise, and relationships accumulate and build upon one another to your benefit. It's like earning a compound return on your investment and watching its value grow exponentially over the years. In the workplace, your daily wins and experiences accumulate and multiply, producing a far richer and more robust professional journey. And to top it off, one small choice at work or a bad year in the market won't make or break your career. Instead, it's how all the parts come together when given the time. So, and she goes on to give an example of global equities have rewarded investors with tremendous growth of wealth through compounded returns. The key is to stay invested and let time work for you. Here's an example. If you invested $1 from 1988 to 2022 in the world market, that's the entire world equities, your $1 would have grown to $13. That's 1,300% growth. Putting that into more applicable numbers, if you would have had $100,000 in 1998 invested with no additional savings in the global market in 1998, it would have grown to about $1.3 million by 2022. That's of course not including transaction costs or taxes or advisory fees. But the point is, there's an opportunity cost to everything we do. So if you could have had $100,000 in 1988 and then grown to $1.3 million in 2022, that's pretty significant, right? You can scale that with any amount, right? 1 million to 13 million, however you want to do that. But the point is, if at any point during that time you'd have overreacted to market corrections or world events, anything like that, and pulled your money out of the market and then stopped the power of compounding over time, your money wouldn't have kept growing. Okay, so that's an extremely valuable point brought up by Stacey winning. All right, on to the next story. Control what you can control. Control what you can by Bryce Skaff, co-head of Global Client Group at Dimensional. He goes on to say, last year I was surfing in Hawaii when I felt a tightness in my chest. A wave of crippling pain washed over me, and I couldn't breathe. We rushed to the hospital, and the cardiologist said I had suffered a major heart attack. Thankfully, I walked out of the hospital the next day to begin my road to recovery. The doctor said my years of discipline around personal wellness probably saved my life. In hindsight, the experience helped me see the parallel between health and financial well being. While we cannot control what happens in the markets or life, preparation can help us get through the tough times. I couldn't predict a heart attack, but through healthy living, I had been preparing to survive one without knowing it. The same applies to investing. We can prepare for uncertainty and extreme events by focusing on controllable factors, such as saving, diversifying, managing risks and costs, and practicing discipline. On that fateful day, I controlled what I could by staying calm, trusting my body, and letting the doctors do their job. The experience was a reminder of how preparation, discipline, and quality professional guidance can help us weather any storm. To position for different market outcomes, investors can choose an asset allocation that reflects their time horizon, financial goals, and risk tolerance. I love this story, one, because it's a really good example of we often are preparing for unknown life events. It's the unknowns that will often, and how we react to them, that will often dictate, or how we can weather them, that will often dictate whether or not we succeed or not in life, or survive or not in life in this example. I also enjoy it because far too often do I see people having their money invested in such a way that reflects what their friends and family are doing, but doesn't necessarily reflect what their personal goals are. All right, so it's extremely important to understand one, we're preparing a lot. We can plan for what we want to happen, but we should prepare for what can happen. And two, build a financial plan and investment portfolio that fits your goals, not your neighbors. All right, next story. Planning Over Prediction by Savina Rizova. Hopefully I'm saying that right. Global Head of Research for Dimensional. She goes on to say, I became a petrol head 18 years ago when I met my husband, and we've since attended F1 races all over the world. I see many similarities between fast cars and investing. First, you need expertise in both endeavors to transform science into practice. Combining robust insights from scientific models with real world considerations can help you plan and eliminate much of the guesswork in building an investment solution or racing machine. Science is the engine. Technology is also crucial. F1 technology means carbon fiber, wind tunnels, and computational fluid dynamics software. Systematic investing involves scalable databases, platforms, and processes that guide daily portfolio decisions. Both efforts also require a process for collecting and evaluating a huge amount of information. 2 gigabytes of data are sent by the race car to the team in just one lap. A robust investment approach may process hundreds of thousands of data points each day to help inform portfolio positioning and rebalancing. In systematic active investing and racing, the objective is to outperform. While you cannot accurately predict the result, planning for a range of possibilities can help you get the most from design, technology, and information, and reduce the role of chance in the outcome. Financial science offers insight into the drivers of higher expected returns. Rather than trying to predict which securities will outperform, investors can follow a systematic process in an effort to capture what the markets offer. Next story, Uncertainty and Opportunity by Brad Steiman, Head of Wealth Management Group Canada. After many years of public speaking, I had an unexplainable panic attack during a presentation. Later, the anxiety I felt about having another episode was new and uncomfortable to me. In search of an answer, and thanks to my mother, I discovered positive psychology, the scientific study of what helps humans flourish. Since then, I've read many books about the personal qualities that lead to a greater sense of well being. I've also learned ways to manage anxiety. When you sense it coming, lean into it. Rather than resisting the uncomfortable feeling, greet it like a friend and much of it goes away. Resistance only makes it grow. How does this connect to investing? Resisting market downturns that inevitably will occur fuels anxiety as an investor. However, rather than merely accepting the setback, embrace it because risk and return are related. You cannot achieve much in life or investments without accepting uncertainty. Life's setbacks are rarely as bad as you fear. Stay focused on the important things, the rest will come. Next story, The Value in Flexibility by Banu Singh, CEO Australia and head of head of the Asia Pacific Portfolio Management. He says, at 14, I moved with my family from a small village in India to Los Angeles. That began a life of change and adaptation for me. After college, I expected to work in accounting. Instead, I learned about Dimensional and joined the firm as a trading assistant in Santa Monica. I didn't know much about asset management and trading, so I leveraged my computer programming courses to help create tools for the trading desk. Throughout my Dimensional trek from Santa Monica to Chicago, Sydney, Austin, and back to Sydney, I had to adapt to different roles, personalities, and cultures. Now Sydney is home. In life, we should all expect change and be ready to respond. The same goes for investing. Stock prices change continually as markets adapt to new information. When managing portfolios and trading, being flexible can result in lower costs, better prices, and higher returns. Flexibility can help you add value in dynamic markets, just as it can help you navigate life. Markets around the world are adapting every second to new information and to changing expectations. A flexible investment strategy can make the most of the opportunities the market present. And I think this is really important, not only just when investing in the markets from a diversified standpoint, but also investing outside the markets. One of the most valuable things that I believe anyone and everyone should likely have in their planning portfolio is a war chest of money that isn't dependent on the market. So that when the market's fluctuating and an unexpected life event or an opportunity comes up, you still have liquidity and you aren't forced to potentially sell when the market's down. All right. So overall, when it comes to investing in the stock market to grow your wealth, to prepare for and enjoy your retirement, remember the power of compounding, control what you can, planning over prediction, uncertainty and opportunity, and the value in flexibility. Disclaimer, past performance is not a guarantee of future results. Indices are not available for direct investment. Therefore, their performance does not reflect the expenses associated with the management of an actual portfolio. This is an example for conceptual learning around the power of compounding only. This content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation. Thank you for your time, and remember to reach out if you have questions or would like a copy of this 43-page in-depth investing matrix. Please share, comment, or like this Money Not Math episode if you enjoyed it, and thank you again so much for your time. I always enjoy these conversations, and I really appreciate the feedback. Thanks, and have a great day. Bye.